Please come to this wonderful chapter, mutual fund, again. Now we will first discuss today advantages of mutual fund. Give me 5 benefits of mutual fund. Student of SFM batch. Low cost, okay. Diversification, very good. Less time consuming, okay. Professionally managed, less volatile. Okay, so it seems you have done good job. Now come to the advantages in your book. First advantage is mutual funds are professionally managed. First point, these are managed by highly talented, qualified, skilled, experienced managers. They have a lot of experience in the field of investment. They know when to buy, when to sell, in which proportion to buy, and therefore you can be relaxed. You as an investor, don't worry. You be assured that your funds are with professionals. Their income, that is the salary of the professionals who manage, it also depends on the performance of the mutual fund. So they will also try their best to ensure that the investor gets a high rate of return, so that more and more people will invest in that mutual fund. They will get more incentive and remuneration. So one day you can also become portfolio manager in a mutual fund. Okay. Second advantage is diversification advantage. Mutual funds offer diversification in portfolio which reduces the risk. Suppose you have 10,000 rupees. You invest in a mutual fund. Mutual fund invest in 30, 40, 25, 100 shares. So with 10,000 rupees also, indirectly you are getting the benefit of diversification. Diversification reduces the risk. If there is a volatility in the market, if the share prices fall, all share prices will not fall at the same point of time. Some may fall. If they fall, some may rise also. Some may fall, some may rise also. And therefore, you get the benefit of diversification. You would not lose money all of a sudden. Had you invested directly 10,000 rupees, you might have invested in 1 or 2 stocks. And if the share price of that particular stock goes down, you would suffer the loss. So why mutual funds are so popular nowadays? Because of the diversification benefit. Third reason why we should invest through mutual fund is convenient administration. That is, managing your mutual funds is very simple. Managing your mutual fund is very simple, less administrative hassle. What you have to do, you have to just open a bank account and you take a portfolio number from a mutual fund or folio number, and then you can just buy and sell. You can now buy and sell using online, internet. Okay, it's very easy to buy. You just have to log into your account, press buy, press number of units you want to buy or amount you want to buy, tick the scheme you want to buy, make the payment through NEFT or your online transfer. Done. You want to sell, just tick mark which scheme you want to sell. You can do it. If you also can't do it, you can take the help of your advisor. You just have to tell them this is the scheme you want to buy or sell, he can do it. Managing the records is also very easy. Mutual funds give you all the information. Suppose you want to know the information, it is available. You can ask them, what is my capital gain during this year? They can tell you. They can give you entire history of the entire year's transaction. Okay, so it is useful for record keeping also. You can maintain books of account based on the statement received from the mutual fund. Okay, So that is called convenient administration. Once you learn this mutual fund management, it becomes very easy to handle your mutual funds. Another reason you should invest in mutual fund is high return. High return. What is the meaning of high return? Compared to other similar investment avenue, the rate of return is usually higher. Let us say you invest in FD, government bond, debenture, okay, PF, Provident Fund, PPF, PF, or insurance schemes. Compared to these products, it has been observed that the mutual fund generates a higher return. Okay, these schemes give you 6, 7, 8% return. Some of the interest earned here is taxable also. So net effect is you earn somewhere between 4 to 5% after tax effect. Whereas it has been observed that mutual fund generates much more than that, say around 10 to 14%. And if you can invest for a longer period also, then it can be 16 to 18% also. However, mutual funds are subject to market risk. But still it is better, and there is a lot of tax advantage in mutual fund. There are many tax advantage in mutual fund. You receive dividend which is tax free. You don't have to pay tax on dividend income. Then long term capital gain up to a certain limit is exempt also. How much is that? Say 1 lakh. After that, only if you earn long term capital gain, you have to pay tax, that too at a very low rate of interest, 10%. Okay. So that is a tax advantage in mutual funds. So your post tax return of investing in mutual fund can range from 8 or 10% in case if you invest in debt fund or bond fund, and it can go to 14, 16, 18% if you invest in equity funds, balance funds, okay, growth funds, where you money is parked in equities. So that is why mutual funds are good in terms of returns also. This is already seen from excellent return mutual funds have provided in the past few years. One should look at the average return provided by the mutual funds, particularly in the equity scheme during the last couple of years. So this is an advice for you. Mutual fund managers or these advisors may say, see, this mutual fund has generated 18% return in the last year. Don't look at 1 year return. What you should do, should look at 1 year return, 5-year return, 10-year return. Since inception return also they give you. Since inception, that means since this mutual fund was established, from that year till today, how much rate of return? So if you're a long-term investor, you would look at these averages, not just 6 months or 1 year return. In 6 months, 1 year or 2 year, we can't judge the performance. But in the long run, 5 to 10 year or above, if they have given a high return, then that is the basis for taking the decision. And mutual fund can provide you a very history of that in scheme. From beginning till today, whatever information you want, they can provide you. Then some of the student had told me mutual funds have an advantage in form of low cost. What is low cost? No mutual fund can increase the cost beyond prescribed limit of 2.5% maximum, and any extra cost is to be borne by the AMC. Now, mutual fund incur expenses, which is ultimately borne by the investor. But SEBI has said your expense ratio cannot be more than 2.5% expense ratio. That is the expenditure incurred to run the mutual fund. Anything you incur more than that, you have to pay from your pocket. You can't load it to the investor. If you are a direct investor in the share market, if you're a direct investor in the share market, then your cost of managing your own fund will be very high. You will have to pay brokerage at the time of purchase. You have to pay brokerage at the time of sale. And your own time, energy, efforts will be involved. Okay. So it is better that you can go through mutual fund. This is again a maximum they have written. It can be less than 2.5% also. Okay. For some schemes like debt schemes, this is much lower because there they don't have to take that much effort also. So low cost of management. They may charge you sometimes exit load. They may charge you exit load. What is exit load? Charges levied by the mutual fund at the time of redemption, exit. And what is entry load? Charges levied by the mutual fund at the time of sale of mutual fund to investor. But now many mutual fund do not charge you entry load. SEBI had said now you will not charge entry load. Maybe you can charge just few hundred rupees. Earlier they used to charge 2%, 2.5% of the NAV as entry load. Mutual fund managers use this money to pay commission to the advisors, to the mutual fund agents, so that they will promote their scheme. So that means there is a clash of interest. The advisor would promote that scheme more, where he gets more commission. Is it right? Like a chemist or a druggist sell that medicine only, where he gets more commission. The doctor recommends that medicine, where he gets more commission. The doctor recommends that pathology lab, from where he gets more cut. Teacher recommends that author, from where he gets more commission. No, teachers are still good enough. We don't know actually. Okay. Next benefit, liquidity. Anytime you can buy and sell. Except in that ELSS scheme, where there is a lock-in period of 3 years, or some solution oriented scheme where they may say that you cannot transfer for 5 years. Okay. Other than those schemes, ALSS or solution oriented scheme, most of the mutual fund schemes are very liquid. Suppose today is Monday morning, you tell them that I want to redeem my money. You either fill the form or online you can place the redemption request. Within 3 working days, the amount will be transferred to your bank account. In fact, sometimes they take less than that also. It may be 2 days also. Sometimes it may be 1 day also. If you place the redemption request early morning, then maybe by next day, the amount will be transferred to your bank account. Do they charge anything for that? No, except if they already mention in the scheme about exit load, then they will charge you. Many of them don't charge you exit load, but again some of them do charge exit load also. Suppose you are a closed-ended scheme, then there is a stock market. Yes or no? Closed-ended schemes are traded on the stock exchange. ETFs are traded on the stock exchange. So if any time you want to sell, you can just go to the stock market and you can sell those units. So there is a liquidity in both open-ended and closed-ended. That has made mutual fund very popular. Okay. Now, because SEBI regulations have also been introduced, SEBI is continuously watching their activities, monitoring them, asking them to follow guidelines, regulations. mutual funds nowadays, their activity have become very transparent. That means if you want to know anything about the mutual fund, you can ask them and they will provide you the information. Okay. Where do they invest money? You want to know the list? They will. In what percentage they have invested their funds in different stocks? They will. Who is the fund manager? What was the performance in the last 1 year, 2 year, 3 year, 5 year, 10 year? What is the entry load? What is the exit load? So all information is made available to you. You can ask for their offer document and every information that you usually need will be available there. So you can take a more informed decisions. SEBI regulations now compel all mutual funds to disclose their portfolios on a half yearly basis. So every 6 months they disclose their portfolio. Where have they invested? However, many mutual funds disclose this on a quarterly or a monthly basis. Some of them are more proactive. Quarterly, monthly basis also. They calculate NAV on a daily basis. NAV, net asset value, we'll discuss the calculation part, is on a daily basis in the case of open-ended funds and now are published through MFI in the newspaper. You can now go through their website also. You can go to the website of say MFI. You can see the daily NAV. You can go to respective mutual fund house website and you can see the NAV, or there are some special websites, say for example moneycontrol.com, where you can see the NAV and then you can understand whether the NAV has gone up, come down. So that is why these mutual fund schemes are getting more and more popular. Once people start understanding, then they will invest in mutual fund. What are the other benefits mutual funds provide? You can follow systematic withdrawal plan, or you can join systematic investment plan according to the needs of the investor. Is it printed? What is systematic withdrawal plan? It is similar to pension scheme. Similar to. That is, you deposit a lump sum amount and then you can withdraw periodically a certain amount. Suppose you retire, you have 30 lakh rupees retirement corpus. You can invest in this mutual fund systematic withdrawal plan. That is very simple. And then you can request them that I want 5,000 rupees per month or 10,000 rupees per month. And accordingly, they will keep transferring 5,000, 10,000 rupees as per your request every month. So till there is a balance in that fund, they will keep on transferring the amount to your account. Very simple. So you don't have to go to bank every time. You don't have to request anybody. You are on your own. Your life is simple. Reverse. You are a student. You want to promote or have a saving habit. SIP. SIP. Every month, one SIP. Okay. 5,000 rupees, whatever stipend you get, you can start investing in SIP. So this promotes regular habit of saving among the investors. So that is a very good scheme. And after some 10-12 payments, if you want, you can stop it or you can continue it. So they give lot of flexibility. The investor can also switch from one scheme to another without any load. Suppose you want to move from debt fund to equity fund or equity fund to debt fund. Many times they will not charge you any entry load or exit load. The same amount will be transferred to other scheme. Now in India, mutual fund is highly regulated. You will find that SEBI guideline is applicable to mutual fund. Strict norms are there. Okay. They have to get themselves registered with SEBI. All the participants yesterday we saw, custodian, depository, transfer agent, okay, AMC, trustees, sponsors. So all these people are regulated by SEBI. Periodically they have to submit some reports. But what is one major advantage of mutual fund investment is the economies of scale benefit. Individual investor can invest a limited amount of money, 1 lakh rupees, 5 lakh rupees, 1 crore rupees, 2 crore rupees. But how much amount this mutual funds invest? Hundreds of crores of rupees, because they raise funds from hundreds and thousands of people. Okay, so they have a huge amount of money to invest, and therefore they have an advantage. They also pay brokerage, but broker charge them a very low rate of brokerage. If you purchase shares through a broker, how much do you charge? Depending upon client, 0.25%. On a higher side, 1%, 0.75. And how much do you charge to mutual funds? 0.01%, sometimes 0.001% also. Very low. Why? Because in one transaction they will give you a business of 100 crore. So 100 crore rupees multiplied by 0.01% is a big amount for you. Effort is the same. Effort is the same. So therefore this benefit of lower brokerage is passed on to whom? To the investor only, because if mutual fund expenses are lower, the NAV would be higher. So economies of scale. If you hire a professional portfolio manager personally for you, he will charge you a huge amount of money for advice. Okay, some of them take 10% of your profit in a year as their remuneration, 15% of the profit as remuneration. As compared to that, these mutual funds are managed by highly qualified professional people, and they do not charge you for that. So they pool money from a number of investors, ensure that mutual fund enjoys economies of scale. It is cheaper compared to investing directly in the capital market, which involves higher charges. This also allows retail investors access to high entry level market like real estate, and also there is greater control over the cost. Now suppose you think real estate is a booming sector. Okay, I want to purchase this mall. Example, this mall is of 20 crore rupees, I want to buy, but I don't have 20 lakh rupees also in my pocket. So what will I do? There are mutual fund schemes which we are going to learn soon. They invest in real estate investment trust. Okay, you invest in that scheme or that fund, they will pull money from large number of people, they buy property, they invest in these big shopping malls, okay, whatever properties, land, and either they earn rent or they get capital appreciation, and it is transferred to the investors. So even though you can't buy the property, you can invest through mutual fund and enjoy the prosperity of that property. Is it right? Like I said, gold, you can't buy gold, suppose. You can invest in this gold ETF. Mutual fund has a serious advantage. They give lot of flexibility to the investor in terms of amount. Any amount you can invest, only minimum some 5,000 rupees like that is there. You can withdraw anytime. You can switch from one scheme to another scheme. Okay, you can go for SIP, you can go for systematic withdrawal plan according to your needs. There are solution oriented schemes also, like you want to save for retirement, there are retirement funds. You want to save for child education, there is a children education fund. Okay, you want to save income tax, there are ELSS scheme. You want to invest in that index fund, you want to enjoy the benefit of rise in Sensex, there are index funds. You want to enjoy benefit of gold, real estate, infrastructure, there are schemes. Okay, so this line says there are wide range of schemes launched by India by different mutual fund. according to your risk taking ability, according to your interest, you can invest. You can plan your portfolio. And the last point for this highly qualified people like you, tax benefit. I have not written any explanation there because CA student doesn't require any explanation when it comes to tax. So what are the 2 or 3 advantages of investing through mutual fund? Tax benefit. Dividend is exempt. Capital gain is charged at a lower rate. Up to a certain limit, exempt only. Up to what limit? Long term capital gain in a year. If it is up to 1 lakh, then exempt. Up to 1 lakh. Then 10 or 20%, I don't know. With or without indexation, 10 and 20%. So what you can do, you can take lot of mutual fund scheme in the name of family members. In a year, do not let it exceed 1 lakh rupees profit and don't pay tax. Then ELSS benefit is there. Hello, ELSS benefit is there. Up to 1,50,000 rupees you can invest. And what about short term capital gain? Is it charged at a lower rate or same rate? Up to 1 lakh exempt. Government will keep changing that regulation, so keep a watch on this. For dividend it was fully exempt. If your income in a year is more than 10 lakh from dividend income, from equity scheme, then you have to pay tax. Good, I don't have to pay. My dividend income is less than 10 lakh. Capital gain is more. Must be having 3 to 4 accounts. Why should I tell you? What are the drawbacks of mutual fund? What are the drawbacks of mutual fund? There are advantages, no doubt, but one should also look at the other side of this mutual fund schemes also. But these disadvantages are not very serious. You can overcome them if you are careful, if you are alert. First is, you should know there is no guaranteed return. There is no guaranteed return. Even though these mutual fund houses or their agents or their advisors, in order to attract the investor, they will say this scheme gives 15% return. But that is only based on past performance. Past performance may or may not be repeated in future. And that is why mutual funds give disclaimer also nowadays. What is a disclaimer? Mutual funds are subject to market risk. Past is not the guarantee of future. Okay, which means past is not the guarantee of future. So even if in the past they have performed well, it is not necessary in future they may perform well, because it depends on many factors. So there is no guaranteed return. All mutual funds cannot be the winner. There may be some who may underperform the benchmark index. That is, they may not even perform as well as the index in which they have invested. Okay. Point number B in that same heading, no guaranteed return. A mutual fund may perform better than the stock market, but this does not necessarily mean a gain to the investor. Why? The market may have risen and the mutual fund scheme increased in value, but the investor would have got the same increase had he invested in the risk-free investment than in the mutual fund. But market suppose has gone up by 6% and your scheme has also gone up by 6%. Still it is not a case of high return, because you could have earned the same return by investing in a government security also. So it is not enough that they must generate the return. They must generate a return more than the risk-free rate of return. Investor may forgive if the return is not adequate, but they will not do so if the principal is eroded. Underline, mutual fund may result into depreciation in the value also. Mutual fund may result into loss also if you had invested 10 lakh rupees at the beginning, your NAV may be less than 10 lakh rupees at the end. That is a risk. Okay. They have to mention the risk involved in the mutual fund. Yes, you can add that in case if you find, if the mutual funds tell you what is the risk involved. Yes. Is it mandatory to tell the risk? Barometer. Yes, nowadays SEBI says you tell the investor everything. So that is also an advantage. That was in the first point. Transparency. If not first point. So you can add in transparency. You can write in transparency that now mutual fund also tell the investor about the level of risk. Whatever extra point you want to add, you can add. Next is, what is the drawback of mutual fund? Mutual fund help us to diversify. That is an advantage. Diversification reduces the risk. That is also an advantage. But diversification may not help us in maximizing the return. This is a disadvantage also. Sometimes what happens, they invest in 100 stocks. 50 of them perform well. 50 of them do not perform well. So the loss of one is compensated by gain in another. But as an investor, now what happened? Your rate of return goes down. Instead of that, you think that had I invested directly in the stock market, I could have earned a higher rate of return. So this is often complaint of the equity investor, that return on equity share is more than the return on mutual fund. Of course, that involves a high degree of risk also. For example, a single security held by a mutual fund doubles in value. Oh, good news. The mutual fund itself will not double in value. Your NAV will not double because that security is only one small part of the fund's holding. So sometimes diversification has its own disadvantage also. Had you invested only in this stock directly, your money would have doubled. By holding a large number of different investment, mutual funds tend to do neither exceptionally well nor exceptionally poor also. So that is why you have to make a choice. Mutual fund helps in reducing your risk. So as we have learnt in SFM also, you can't have best of both the world. You can't have maximum return and lowest risk. So if you are reducing your risk, be happy with a lower return. Okay. So many people will give you this advice also, that you should not invest in mutual fund because they reduce your rate of return compared to equity market. I agree, but then you are not comparing the two properly. They have different level of risk. Equity market has a very high risk. And point number C, selection of fund. One more problem nowadays is, where should we invest? Okay. Earlier only UTI was there, so this problem was not there. Then some more public sector mutual funds started, then also this problem was not there. But now in India, there are more than 40, some 42 or 43 mutual fund houses, and each of them has 50 schemes average, suppose, on an average. So that means there are 2000 options available to the investor. Where should he invest? Is it right? So that is one problem with the investor now. For stock, one can base his decision on the parameters like economy, industry and company analysis. Now this note says it is easier to invest in stock than the mutual fund. Again, these opinions can vary from person to person here. Because you know, this is Tata Motors, they are into automobile industry. What will automobile industry do in the next 1 or 2 years? Easy to understand. But if you invest in a mutual fund which invests in 100 shares, you really don't know how this mutual fund will perform. So this is what they are saying. In case of mutual fund, past performance is the only criteria to fall back upon. How do we select a mutual fund? By looking at its past performance. But a student of CA final knows, and who knows it better? Past is not the guarantee of future. Yes or no? You will realize it soon. Cost factor. Is mutual fund free of cost? No. Nothing is free. If it is free, then there is a heavy cost behind it indirectly. So in case of mutual fund, even though the entry load is not there, exit load is not there, but there is an AMC fees. There is a AMC fees. The company which manages your investment is called asset management company, and they take some percentage of asset under management as fees, okay, which can go up to 2.5%. So if they manage 1000 crore rupees, something like 25 crore rupees will be their share in that. Why they charge so much of fees? Because mutual fund managers, they are highly paid executives. So there are people like you who have lot of experience, and their salary run into crores of rupees. The top fund managers, their salary is 4 crore rupees, 5 crore rupees, okay, plus all other benefits. Then some of the mutual fund charge you entry load also. Some of them charge you exit load also if you sell within say 1 year, okay, or some of them will charge you definitely exit load whenever you exit. So different schemes are there where entry load is exempt, entry load is exempt after 1 year, or it is not exempt at all, and such costs reduce the return from mutual fund. The fees paid to AMC is in no way related to performance. One more complaint of the investor is that even if the mutual fund has generated negative return in a year, but one person will be happy, the AMC, because their fees is not related to performance. Their fees is related to asset under management. Okay. And the next is unethical practices. What is unethical? Not a fair game. Because in past it was observed that in past some of the mutual funds, they have helped their sister concerns. Yesterday I told you that many mutual funds are managed by corporates. The sponsor is a corporate. Maybe Reliance, Tata, Birla. Okay. Why do they run this mutual fund? Because there are many companies and those other companies might need funds. So what do they do? Through the mutual fund, because it has got a lot of money, they invest in those sister companies. Even though the fund manager knows that it may not be a good investment, but who cares about the investor? Here my objective is to first help my sister concern. Each scheme may sell some of the holdings to its sister concern for substantive notional gains and posting NAVs in a formalized manner. They can manipulate the NAVs also. Okay. But now SEBI has become very strict on this. You may not be knowing, but that UTI was divided into two entities, and one of the reasons was some unethical practices going on in that UTI scheme at that point of time. And next drawback is tax. You have to take care of your taxation because you may have to pay short-term capital gain tax. If you may have to pay long-term capital gain taxes also. Okay. So while making decisions about your money, fund manager do not consider your personal tax situations. For example, when a fund manager sells a security, a capital gain tax is triggered. He sells the shares, but then there is a capital gain. which affect the profitability of the individual also. It might have been more profitable for the individual to defer the capital gain liability. Mutual funds will earn more money means investor is also earning more money, and that means he will have to pay more taxation. Okay, mutual fund earns capital gain, it will increase the NAV. Investors sell the mutual fund units, he will also make capital gain, and he might end up paying more taxes. Had the mutual fund sold those investments at a later date, you could have saved those taxes. Transfer difficulties. What is that? Complication arise when mutual funds when a managed portfolio is switched to a different financial firm. Sometimes the mutual fund positions have to be closed out before a transfer can happen. So if you want to move from one mutual fund house to another mutual fund house, it will be like this. You have to first redeem this mutual fund house unit and then invest in the other mutual fund house. In case of share, you can change your depository participant. They will transfer the share from your old demat account to your new demat account, but it may not happen in case of this. Can be a major problem for the investor. Liquidating a mutual fund may increase risk, increase fees and commission, and may result into capital gain taxes also. Then point number H, again an important drawback. You have to depend on the skill, experience and analysis of professional managers. So you are dependent on some professional managers. Return on the investment depends on manager skill and judgment. Investor invest their money in mutual fund on the basis that they have faith in some fund manager. This point you should note. There are some star fund managers. Star means they are very reputed in the market. Okay. Like some people invest in HDFC because there is a particular fund manager. What if that fund manager suddenly leaves, resigns? You can't blame the mutual fund for that. Okay, at the most what you can do? Redeem. But again, we have seen in the previous point, if you redeem, liquidity issue, capital gain tax, commission, cost will increase. If that fund manager leaves, investors have to depend on the skill and judgment of some other manager. So that is one problem, because the fund managers can move also to another company. He may retire also. And then this is again a very serious problem. Sometimes the small investors suffer on account of action of the large investors. Is it possible? So this is a small investor. This is a big investor. Now this big investor, let us say it's a corporate. Let us call it a company, Bajaj Auto Limited. They have parked their money in the same mutual fund scheme where you have also invested. So you have invested your hard-earned stipend of 50,000. They have invested 500 crore rupees in that scheme. Now this Bajaj Auto Limited needs funds for their expansion, acquisition. So they will place a redemption request with the mutual fund house. No problem. Now if the mutual fund house gets such a huge redemption request, for example, do they have so much of their cash and bank balance? Will a mutual fund keep 500 crore rupees in their cash and bank account? Okay, we were waiting for you. Take this check. They invest the money. Some portion they will keep in cash and bank based on their past experience of daily redemption requirement. Okay. Yes or no? They also have a track that per day how much redemption request comes to us. So they will have to sell the shares. Mutual fund, in order to raise this much amount of money, they will have to sell the shares. Now see the bad luck. On that day, the mutual fund had went to sell the share, the market had crashed. Market had crashed. So that means they will have to book the loss. The moment they book the loss means NAV will go down. So the small investor, he found that his NAV was 15 rupees yesterday and today it has become 10 rupees. Because of the excessive loss suffered by mutual fund, it will get reflected in the lower NAV now. So his wealth will get reduced. That is called small investor. Suffer on account of action of large investor. Because large investor may opt for a heavy redemption and on a wrong day, it may result into losses to the mutual fund. NAV gets reduced. Small investor will suffer. Now today I am going to solve few questions. First come to evaluating the performance of mutual fund. Under that, one important calculations we will learn, which is there in SFM syllabus also. Calculation of NAV, net asset value. Very simple calculation, assets minus liabilities divided by number of units. What does NAV means? If you see the meaning of NAV, it means if I redeem all the mutual funds today, how much amount I will get per unit. Or if the mutual fund suppose winds up the scheme today, sells all the asset, discharges all the liabilities, how much amount per unit investor will receive is called net asset value. So it is simply put, it is like this. This is the asset of the mutual fund, particular scheme. This is any liability, and then this gives you net asset. This is a surplus left, and divide by number of units. So per unit, how much amount you will get is NAV. Now what is the role of NAV in this chapter? The role of NAV is that if you want to buy or sell mutual fund, you can buy or sell at NAV. Buy or sell at NAV. Of course, subject to sometimes entry load or exit load. Sometimes entry load is charged, sometimes exit load is charged. But at least the base for calculation is NAV. An investor in a mutual fund is a part owner. Investor is a part owner. He is a proportionate owner in the net asset. Return to the investors are determined by the interplay of two elements, NAV and cost. Now, for an investor, if he wants to know how much he has earned, he will compare NAV at the beginning, that is when he bought it, and NAV at the end. If this closing NAV or NAV at the end is more than the NAV at the beginning, it means he has earned a positive return. Subject to if he has received dividend, that also will add in the calculation. But in general, by looking at the NAVs, we can get an idea whether the investor is earning a positive return or negative return. Okay. It is the basis for assessing the return that an investor has earned. So aspects which needs to be highlighted. NAV is the net value of all assets and liabilities. NAV represents the market value of total asset of the fund minus total liabilities attributable to those assets. NAV changes daily. Yes or no? No. On Saturday, Sunday it does not change. Whenever the market is open, then at the end of the market, it will change. The value of the assets and liabilities changes daily. Because mutual funds primarily invest in the securities only. Shares, debentures, bond, real estate, gold. And the value of this asset changes every day. So if the value of the asset will change every day, The NAV will also change every day. NAV today will not be NAV tomorrow or day after. NAV is computed as a value per unit of holding. So after all these 6 time pass statements, come to the topic, main topic, how to calculate NAV. Okay, same lines they repeated 6 times. Yes or no? But still you should write, because true false question can be asked. NAV changes daily. So you should say true. Don't say no, my sir has told on Saturday and Sunday it doesn't change. So it's a false statement. It is true. How to value assets and liabilities. So your institute has given some suggestion. You will be given a long question, okay? Or you may be given a full balance sheet also of a mutual fund. Liquid assets like cash, just take as per book value. Whatever is the cash and bank balance will remain as it is. In case of listed and traded securities, other than those held as not for sale, that means those which are traded on a routine basis, you can simply take the closing market price. Then debentures and bonds, closing traded price or yield basis. So maybe you have to value some investment using yield formula. For illiquid shares or debenture, the valuation rule is last available price or book value, whichever is lower. Last available price or book value, whichever is lower. Estimated market approach, price approach is adopted if a suitable benchmark is available. Estimated market price may be taken if a suitable comparable company or a benchmark is available for illiquid shares. For fixed income security, it will be based on current yield. That means again you will have to do the valuation based on whatever discount rate they have given. And after, these are basically your main assets. These are the main, you can say this comprises of 90 to 95% of the assets of the mutual fund, because they invest in shares only. Some minor adjustments you'll have to do. Following items will be added on the left side. Dividend and interest accrued will be added to your assets. Any other receivable which is considered good, add, or any other owned asset will be added. So these are the amount you have to add to the previous answer. And then deduction for liabilities. There may be few liabilities of that scheme, like for example expenses accrued, like this management fees has accrued, AMC fees has accrued, salary of that fund manager has accrued, whatever has accrued. Any liability towards unpaid asset, deduct. Any short term or long term liability, deduct. So this will be deducted. And after you have done this calculation, then you apply the basic formula of NAV, net asset of the scheme divided by number of units. Okay. So this is called NAV. The investor's subscription is treated as the unit capital in the balance sheet of the fund, and the investments on their behalf are treated as asset. Now how to calculate net asset, I have again written in detail. Wherever possible, take market value of the investment. To that you add other assets like receivable, accrued income, other asset, and from that you deduct accrued expenses, other payable and other liabilities. That's it. Mutual funds are required to publish their NAV on a daily basis now, which I think we have read somewhere today. And based on the NAV, you can buy or sell. NAV will help us to also calculate the rate of return that you have earned. So this is a question taken from ICI book only, Financial Services and Capital Market book. This question was asked in the exam also in SFM. So institute have taken from there. We have taken from here. So dear student, solve. Based on the following data, determine the NAV of a regular income scheme. Listed share at cost, ex-dividend, cash in hand, bonds and debentures at cost. Then of these bonds not listed and quoted, 1. Other fixed income, interest security at cost, dividend accrued, amount payable on shares, expenditure accrued, number of units rupees 10 face value each, current realizable value fixed income security face value rupees 100, realizable value 106.5. All the listed shares were purchased at a time when the index was 1200. On NAV date, the index is ruling at 2120. It means your value of share will change accordingly, proportionately. The hint of this sentence is that your value of share will change proportionately. Listed bonds and debenture carry a market value of rupees 5 lakh on the NAV day. Now you see on the screen, third line, there is a bond and debenture. Below that it is written bonds not listed and quoted is 1 lakh. Means the remaining bond which are listed and quoted is worth 5 lakh. So you will divide this line into two. Listed bond and debenture, unlisted bonds and debenture. So first 20 seconds I will give you, format is drawn in your notes. Take a pencil, FITB, fill in the blank. FITB, fill in the blank. Let me see who can give me the correct answer. One person is saying 17.12. Okay, 5 seconds more. To other students. Do it properly. Format is given. Just write the numbers. Okay. So the answer was 17.12. Is it right? So see what you do in the exam. Present properly. Presentation is very important. Equity shares, you will write the calculation 20 into 2120 divided by 1200. So this comes to how much? 35.33. Cash in hand 1.23, no adjustment. Bonds and debenture not listed. Not listed is 1. We'll take the book value only. And bonds and debenture which are listed, we will take the market value. How much is market value? 5. Dividend accrued is given 0.80. Fixed income security, you have to do calculation. What is the cost? 4.50. Last line of that question of the table, 106.50 divided by 100. So that means the proportionate value of this fixed income security will be 4. How much? 7925. Wonderful. Subtotal of assets. So please tell me this total. 48.1525. Less liabilities due on share. Due on share, the liability is 6.32. Expenses payable 0.75. Total of the liabilities 7.07. Net asset value A minus B, this minus this, 41.0825. Number of units 2.4 in lakhs. Net asset value in rupees 17.12. You can write 1 2 or you can write in 4 digits also. Is it right? Say yes. Yes, this is how they calculate. Now, since you are a good student, I will give you 2 more questions for classroom practice. This time, no hint, no blank format. You will have to do it. 30 seconds for this next illustration number 2. Try your best. You can do it. You are a good student. Illustration 2, 30 seconds starts now. 1.3, 6.4, 12.8. Oh, different people, different results. 12.9650 is the answer. Okay, rounding off. So let us discuss, then write. Calculate today's NAV of Flexi Fund if the following are given. So yesterday's NAV was 12.8700. Okay. Total number of outstanding unit was 1.25 crore. Means my opening net asset is 12.87 into 1.25 crore. So that will give me opening net asset, and then transaction for the day. Face value is rupees 10. Expense rupees 1 lakh minus. Today what is the expense for running this mutual fund? 1 lakh minus 1 lakh. Assume sales NAV and repurchase NAV both are 12.87. Appreciation of portfolio today 12 lakh. Add 12 lakh. Units fresh subscription received 2 lakh. So add cash received 2 lakh into 12.87. Redemption minus 0.75 lakh into 12.87. Okay. Dividend received 1 lakh. Add. So this will give you closing net asset. Divide by how many units you will have at the end of the day. You started the day with 1.25 crore units plus 2 lakh new subscription minus 0.75 redemption. So the number of units will change at the end of the day. Have you taken care of that? You multiplied by face value. So sad. Write down the answer properly there. Those who have done will check. We have just written what was printed there in a tabular format with rupees. Okay. So my dear students, please write. And you will check yourself where you have gone wrong. First write down calculation of closing NAV. Right hand side rupees. If you want to write rupees in lakh, you can do it on your own. If you want to write rupees in crore, you can do it on your own. Opening net asset, write down. You multiply 1 crore 25 lakh into 12.87. Add less expenses 1 lakh. Go in the sequence of the question, you will not miss anything. Then you point C, add appreciation in portfolio value 12 lakh plus fresh subscription 2 lakh into 12.87. Keep checking the calculation. 25 lakh 74,000 less units dash redemption 75,000 into 12.87. 9 lakh 65 250. 965 250 in bracket. Add dividend received. Total closing net asset A to F, you have to add A, B, C, D, E, F, keeping in mind the positive and negative signs. Is it 16 crore 36 lakh 83,750? Are you checking or copying or both? Both. It is okay. Closing number of units, write properly. Some of you made mistake probably here. You have opening number of units plus 2 lakh minus 75,000. So your closing number of units will change. 1 crore 26 lakh 25,000. Now you can compute NAV in rupees 12.9650. Done. I will try your intelligence one more time. Are you ready? Yes. So dear student, why don't you solve illustration 3 one more practice? And then I suggest you practice more questions from your SFM book also. Okay. More problem on this topic from SFM book you will practice. Please try next question. Read yourself, interpret yourself, and solve yourself. Is it over? Yes, keep trying. 10 seconds more. One person is saying 17.29 or something. Okay. The answer is no. The answer is NAV before dividend distribution 11.551 and after dividend distribution, that is ex dividend NAV, is 10.751. Have you got it? No. Why you have not got it? Okay. Do you want me to explain? Opening cash balance. Okay, I'll explain. Keep the question in front of you and the answer is on the screen. I will give you sufficient time to write. But first understand. Okay. The question begins by saying that, wait, don't get agitated. A mutual fund made an issue of 10 lakh units of rupees 10 each. Means they raised 1 crore rupees. On 1st January 2008, no entry load was charged. It made the following investments. It made the following investment means 98 lakh rupees were invested in the equity, share, government security and 2 types of debenture. So it started 1st January with a cash balance of 2 lakh rupees. Do you agree? And then the problem says it invested in 50,000 equity share of rupees 100 each at 160, 7% government security, 9% debenture, 10% debenture. During their dividend of rupees 12 lakh was received. So what I did, add dividend received 12 lakh. This will also increase their cash. And the problem says interest on all types of securities was received as and when due. Add interest received. 7% government security, that is 7% of 8 lakh 56,000. 9% debenture unlisted, 9% of 5 lakh 45,000. 10% debenture listed, 10% of 5 lakh, that is 50,000. And then somewhere below they have written that expenses paid during their amounted to 5 lakh. So 5 lakh expenses paid. Means my closing cash balance will be 10 lakh 51,000. Who got it right? Closing cash balance. You didn't take 2 lakh. Out of 8 marks, you'll get 2 marks only. That is also on a higher side. It's open book exam, but this question is not there in the ICI material. Wait, this question is not in the ICI material. Even if it is open book exam, you can't find this question in ICI material. Okay, don't worry. You carry SFM book also. You are right, for mutual fund chapter. take a truck with you to carry all your SFM book, class notes, institute material, okay? And then you'll find there's no space on your bench to keep the books only. Mobile is not allowed, nalak. Next line. Equity share. What was the market value of equity share? Now here there is a small confusion. It says that at the end of their equity share and 10% debenture were quoted at 175% and 90% respectively. So should we take 175% of face value or should we take 175% of cost? So it means it is on face value. 50,000 equity share of 100 rupees each means face value is 50 lakh. 50 lakh into 175%, 87 lakh, 50,000. Then 7% government security, no change, 8 lakh. 9% debenture, no change, 5 lakh. But this 10% listed debentures are trading at 90%. So I have taken 5 lakh into 90%, which is 4 lakh 50,000. And now I will get the net asset before dividend distribution. Number of units, you'll get dividend NAV before dividend distribution 11.551. If you pay dividend, your NAV will go down because your cash balance will fall. Am I right? So X dividend NAV, that is after paying dividend, your balance is 10.751. Have you got 10.751? You got it right? No problem. That is why we are practicing. One more question we'll practice little later. So these are the different ways questions are asked in the exam. Now write. Once all of you have completed, please tell me. Do you want me to remove this yellow highlighter? Now you can read properly. Write neatly the way I have written. Each and every working note I have presented. You can write the answer there only. Any query on these three questions? Yes or no? Right. Can we change the method of presentation? You want to change the method? Why you want to change? What is the better way? Will multiply by? See, we have to give two answers in this question. What is NAV before and after? I don't think anything can be further simplified than this. Just you have to reduce 0.80. Any other presentation, that means you have to again change the cash balance. That is more tricky. This is simple. As long as you give these two answers to the institute in detail working, they will give you the full marks. Is it right? Have you done? So now we will take a small break.